sorry about that. I was just forwarding the link to someone. Okay, I think we have most of our guests here already. Let's see, well, thanks for joining us this morning. My name's Christy Simon, President and CEO of the Central Maryland Chamber. I'm so glad to see you here with us today to learn more about tax strategies to help your business in the new year. The Chamber has had a number of great webinars that have been recorded, and they're accessible for free right on our website, which is centralmarylandchamber.org. You can also sign up there for our newsletter and follow us on social media for all of the information and resources that we offer, along with our upcoming events. Next week, we will have another excellent webinar on commercial real estate and flexible office solutions and ways that your business can adapt in this new COVID environment. We'll have a panel of experts from the real estate industry, banking, and architecture that can answer your questions directly. And if you haven't yet joined the Central Maryland Chamber, we would love to have you as a new member. There are so many valuable benefits to membership that I'd be happy to discuss with you following the program. So please keep in touch if you have any questions. If you could please take a moment to add your contact information into the chat box. Following the event, we will share that with the attendees. And also, if you have any questions for our speaker, you can feel free to add them in the chat or save them for a little later in the program. We will have time for Q&A at the end. So without further ado, I'd like to introduce our speaker for today's program. Thanks to Barry for being with us today to share his expertise. Barry Fields Cpa is a senior manager at Bormel, Grice & Hewitt, PA, located in Laurel. Barry received his undergraduate degree from Boston University with a Bachelor's of Science in Business Administration, and he graduated top of his class from the University of Baltimore with a Master's in Science in Taxation. Barry works with a broad base of individuals and businesses in diverse industries, including real estate, medical, legal, restaurants, and consultants. Barry's expertise is in partnerships, individual, and multi-state taxation and tax planning. Without further ado, I'll turn it over to you, Barry.
Good morning. Thank you, Christy, and thank you for the Small Business Committee for having me. We have about an hour, and there's a lot of materials. I'm going to kind of jump right in here. You have a 4-page handout that I guess first and foremost, the most important thing about this handout is over the next couple months, if you can't sleep, break it out in the middle of the night. Don't wake up anyone in the room with you and start reading it. You'll be back asleep pretty quickly. If we get nothing out of this meeting and you get that, I'll consider it a success. Otherwise, it does have some good information. We can't go through the entire 4 pages. Every bullet has a lot to say about. Many of them have more sub bullets within it. So we're just going to try to do more of an overview on the bigger points. Also, as far as tax planning goes, this is December, it's early December, so there's time to do some things now to try to reduce your taxes for 2020. We're still in 2020, or to plan ahead for 2021. One of the rules of over the last few years, really over 20 years, each time there's a tax change, they seem to close what we call loopholes. Tax planning, as far as manipulating from a manipulative perspective, has gotten harder and harder. That's been intentional. So a lot of it is really the number one thing, the best way to save taxes, unfortunately, is to spend money. If you're a business and you pay for deductions, you pay for expenses, you will reduce your taxes. None of what I'm about to, this little introduction piece is not in the handout. Keep in mind, and that's why I have the tax rates here, for every $1 of cash you spend, you'll save roughly anywhere from 50 to 65, 70 cents. 50 cents if you're self-employed, when you factor in self-employment taxes, federal income taxes, state income taxes, for every $1 you spend, you save about 50 cents in taxes. That means you gave up another 50 cents somewhere. So at some point, spending money just to save taxes isn't always the best way to go. Just to kind of point that out. If you need something, if your business needs equipment, if your business needs another employee, if your business needs anything, then it's usually deductible, and it's something to consider at the end of the year, going into 2021, whether you take the deduction this year, spend the money and take the deduction this year, or wait a little bit. Some of the things to do in December is to possibly buy some things now. I say things, but equipment, computers, whatever it may be, buy some things now and buy some things in January to spread it over 2 years. There's, kind of think those things through. So moving on, I always like to say cash is king. To end that topic, cash is king. So I struggle a little bit with how to present this, in what order, what fashion. In the last 2+ years, 2.5 years, there's been a flurry of tax law changes, and especially this year, 2020, there's been a lot of news about a lot of the coronavirus relief efforts. A lot of the coronavirus relief efforts are not, there's some tax, and we're going to talk about them, but a lot of them were unemployment benefits. A lot of it was for payroll tax purposes. We'll talk about that a little bit. The Paycheck Protection Program, but not really specific, tax specific. So we'll cover those a little bit as they intersperse in. What I decided to do is really start with the 2017 Tax Act. The 2017 Tax Act was what we call, this was the, when President Trump first became president, there was a pretty large tax changes. It was December of 2017. That is like that is still the foundation of what we're doing. Anything that was passed, most of what was passed for coronavirus relief efforts, just tweaks some of the things that already changed, and just for 2020. So if I start there, it kind of confuses matters a little bit. We have to have a little bit of a foundation. So I'm going to start with the 2017 Tax Act. That goes on, Tax Cuts and Jobs Act. That goes over the first 2 pages. This time last year, December 2019, there was something that's called the Secure Act. Mostly, a lot of it was retirement benefits and some payroll changes. That's on page 3. And then the coronavirus relief efforts are on page 4. So we're going to start at the top. Again, I'm not going to go through every bullet. Page 1, in my opinion, is the most important page on this 4-page handout to know what's going to change. So we're probably going to spend more time on page 1 than the other pages. But right off the bat with the tax rates, it was big news that all the tax brackets were lowered. The highest tax bracket used to be 39.6%, and it was reduced to 37%. For me, that I'm not in that bracket, it has no bearing on my income. 2.6% doesn't sound like a lot, but if your taxable income is in the millions, it's 2.6 on every number of millions of dollars. So the tax really did add up. A lot of people complained. There was a lot of news. Some people, my taxes didn't go down. And when we came to the conclusion that almost everybody's taxes were reduced. You may not have felt it when you read in the newspaper about the millions of dollars some people were saving. It was all proportional to where you're at on the scale of income. But with the reduced tax rates, most people, I don't want to say everybody, don't yell at me if you're one of those, but most people felt some form of a tax break. It may not have been enough, but your taxes probably did not go up under President Trump. And the reason why I put all the tax brackets here is for tax planning. It's important to know where you stand. These numbers, we're not going to go through them all, but just in general, these numbers are the tax brackets. This is not gross income. This is not what's called adjusted gross income. This is your taxable income. After you take all your items of income, and then you take some deductions, your standard deduction or itemized deductions, and some other things, other items on your return, you get to taxable income. Taxable income is then multiplied by the rates to get to your taxes. So if you know your taxable income from 2019, it's on page 2 of your tax return. If you know your taxable income from 2019, you can get a feel for where you might be in 2020. So if your taxable income was $80,000, then you're in the 22% bracket. And if your employer is saying, hey, I could offer you, you think about a $10,000 bonus, I could pay it to you in January, I could pay it to you in December, you got some options. It's good to know if the next dollar of income is going to put you into the next tax bracket, and try to manage we do this a lot with retirees they're trying to take a large distribution from an IRA. They want to buy a house, they want to do something, they want to, whatever it might be. You don't want to take if you can time it, some in December and some in January, so that you're not jumping tax brackets. But if you look, if you're married filing joint going from 80 to 171 to 326 in 2020 tax brackets, there's a large spread there. But if you were at 160, if you're married filing joint and you were 160 in 2019, The next 11, again, it's adjusted for inflation. Last year was just a guide, but the next 11 after that will put you in the next tax bracket. And if you're looking to take 30, well, maybe you're better off taking 11 now in December, or 10, whatever round, and 20 in the next year, so that this year you'll pay less in tax by doing that. Keep in mind that it just pushes the problem to next year. But things are adjusted for inflation. You never know what's going to happen next year, but the rule of thumb is if you can save taxes this year, save taxes. With the administration, if the administration changes, if there is a new president, I guess I'm kind of being sarcastic, but hey, we don't know. I don't believe, my personal crystal ball, I don't see a huge tax overhaul, especially if the Senate doesn't flip. If we have a split Congress, I don't see this entire bill being ripped up. I also see there are several moderate or right-leaning Democrats. I don't see on fiscal issues every Democratic senator getting on board to just arbitrarily make drastic changes. I'm just like you guys. I read the same news you guys read. So who knows? I don't really, my crystal ball sometimes gets hazy, but I just don't see major changes on the horizon, regardless of what happens over the next 2 years, because there's still going to be a political battle. And even if the Democrats get that 50-50 vote with the vice president breaking the tie at 51, I don't see every Democrat voting with the party on certain fiscal issues if they're going too far. That's my take. I'm going to stop there, but my information is the same as yours on the news. So that's the tax brackets. Just remember, whatever you do this year, if you delay something this year, you're just pushing it to next year. If you accelerate it this year, then you don't have it next year. Moving on to the next bullet, talk about the standard deduction versus the itemized deductions. One of the major changes was for individuals was increasing the standard deduction. It was $6,300 for singles and $12,700, and it was never adjusted for inflation. Well, it was, but it was small, and $12,700 for married filing joint under the old laws. For 2020, it's now $12,400 for individuals, and double that, $24,800 for married filing joint. So if you spend no money in the next couple categories I'm talking about, everyone automatically gets a $24,800 deduction against their income. That's called the standard deduction. I'm going to jump off this bullet for a moment and cover the next three and then come back. So if you're not going to take the standard deduction, then you do what's called itemizing your deductions. And what I call the big three, the three largest deductions available. There's an itemized deduction for state and local income taxes. That's what it sounds like. It's your state income taxes and your local real estate taxes. Under the new tax law, you're limited to a $10,000 ceiling. In Maryland, that could be a pretty significant limitation. A lot of folks, depending on where you live, your real estate taxes alone might be close to, if not over 10. And if your income taxes alone, married filing joint, each you and your spouse might be at 10 each. So that's 30, but you're limited to 10. To knock some rumors, many people in the description I just gave, if you had 30,000, a lot of that was probably added back for alternative minimum tax anyways. Most people weren't feeling the full benefit of all those deductions, and the alternative minimum tax was changed drastically, which we won't really cover. So no one really felt that full benefit of the 30 anyways, even though the media will make you make it sound horrible. So there's about a $10,000, there is a $10,000 cap on state and local real estate taxes. But one area to keep an eye on, if you are in a partnership or an S corporation in a Maryland pass-through entity, Maryland has passed a law during 2020, effective it's effective for, I believe, 2021. And the IRS has already announced that they'll go along with this, is pass-through entities, that's a partnership and an S corporation, can elect to pay the taxes at the business level, and it would be a business deduction. And then bear with me, and then the individuals would get a credit against their income. It's a little confusing, I'll say it again, and it's designed to get around this $10,000 cap. If you're self-employed and you file a Schedule C on your 1040, you're not eligible for this. If you're part of a partnership, two doctors in a medical practice, 18 doctors, lawyers, just, contractor. If you're in a partnership or an S corporation, the business can elect to pay the taxes, the state taxes, not federal, can elect to pay the state taxes at the business level. It's at, I believe, 8.75%. It's at the highest tax rate. It's at 8.75%. The business would pay the tax. The business would get a deduction against their federal income on that. And then that tax, that payment would kind of pass through as a notation on your K-1. And then as a Maryland resident, you're taxed on what's called your worldwide income. And if $9,000 was paid on your behalf as a business tax on a business return, that income comes through to your 1040, to your individual return. You're paying tax on your worldwide income. And so you'd be double taxed in this example, except Maryland would allow a credit against that tax, or possibly, I think it could also be a deduction. But either way, it gets you back to no double tax. This is still in process. The Maryland rule, the way it was written, says be on the lookout for more guidance, be on the lookout for how to do the election, be on the lookout for the forms. None of that is out yet. But it's the way, and more of the states are jumping on this idea. And the IRS has actually already said, okay, we will allow this. So it's a way for folks to get around the $10,000 state and local cap on their individual return. You could have your business taxes paid by the business. You have to be a partnership or an S corporation. And then your individual taxes would not include those from Maryland. That piece is pretty new to 2020, what I just said, the business. The next bullet, the deduction for mortgage interest. I'm not really going to cover this too much. Just know that if you bought a house, you're allowed a deduction for your mortgage interest in itemized deduction. And the old rule was if the interest was on a mortgage of under $1 million, you could take the deduction. And you could also have a $100,000 home equity line of credit, equity line. So your mortgage interest deduction was up to about 1.1 million of debt. Effective December 15th, 2017, with this new tax law, that million cap, at the time this law came into effect, it didn't affect a lot of people. It's 2 years later now. There's probably been plenty of buying and selling, so more and more people are going to be subject to this. It's still a pretty high number. Mortgage interest up to $750,000 is the cap on new mortgages, and home equity lines of credit are no longer deductible at all, even old lines. So if you have $1 million home, or even an $800,000 mortgage on the old rules, and you refinance, you can still take the full mortgage deduction, the interest deduction. This is only for new homes. You sold your own home and you bought a new one. Now you're capped at $750,000, and regardless of your mortgage, there is no deduction for equity lines of credit. So that is number 2 in what I call the big 3. Number 1 was the $10,000 cap on state and local taxes. Number 2 is the mortgage interest, which now has a limit. But again, that limit it's at the higher income brackets. How many folks really have that $750,000 plus mortgage? In our area where we live, there's plenty of that. But there's also plenty of folks that don't have that high a mortgage. And then the third one is charitable contributions, what I call the big 3, because you need to know these 3 to determine whether you're going to itemize or take the standard deduction. And the third one is charitable contributions. You used to be allowed to take a deduction up to 50% of your what's called adjusted gross income. So if your gross income, if your wages and interest and dividends is $100,000, you can contribute up to $50,000 to a contribution for a deduction. In that example, I doubt most people are going to do that. Again, it's the higher income folks who have much more money and a lot more planning, and they have much more to give. But it used to be 50%, and this tax law made it 60%. So in my $100,000 example, and retirees might be interested in this if they don't need the money, if it's coming from IRA distributions.
Hey Barry, can I interrupt for a second?
Yes.
I'm only seeing your screen 1. Does anybody else have the same problem? I'm not seeing your screen 2.
And I
There we go. Okay. All right. I can see it now.
I'm sorry. Thank you for reminding me. I'm right here.
Okay, I got it now. Thank you.
Yep. No one saw it. So the new tax law changed it to 60%, and in 2020 only, I'm going to take advantage of this one. You can deduct up to 100% of your gross income for a charitable deduction. Woohoo! I'm going to do that. I'm just playing around, obviously, but you can. It's a 2020 only rule. Back to 2021, it will be back to the 60% rule. This is an example of what I mean by why I'm not starting with the CARES Act changes. This is a Corona relief effort change. Some people who have the money can give it, and they can give up to 100% and almost eliminate their taxes entirely. One thing that's not on this page, but we're talking about it, if you do not itemize and you take the standard deduction, everyone's allowed a $300, what they call an above the line deduction in 2020. This is new. You can deduct $300 of charitable contributions, even though you're not itemizing. That's very new. Anyone who takes the standard deduction knows their charitable contributions are not deductible. This year you get $300. They're trying to get people to give something and get a little bit of a benefit. So those are what I call the big three. And then in some cases, there's a fourth one, but it's not as big, are your medical expenses. Under the old rule, you can deduct 7.5%, up to 7.5%. Well, the first 7.5% is not deductible of your adjusted. Back to the 100,000 example. What I mean by that is, if your adjusted gross income is $100,000, the first 7,500 of medical expenses is not deductible. So most people don't get. This is really when you had an accident. You don't want this deduction. This is one you don't want. If you have medical issues, medical problems, elderly in assisted living, if you're just living in a retirement, if you're older in a retirement community and you're paying rent, that is not the deduction part. If you've moved into assisted living where it's a medical need, that part is deductible. And you lose the first 7.5%, and everything above 7.5% is an itemized deduction. If you're in this category, it adds up. But again, like I said, this is one you don't really want. They were ratcheting up that 7.5% to 10% number to limit it, to make it even harder to qualify. And what they did was, again, they've made it. It was going to be as of beginning in 2019, beginning last year. They were going to make it 7.5% to 10% of your AGI. And this time last year, they made it to 2020. And then under the CARES Act, they changed 2020 to 2021. So now it's 7.5%. It is still 7.5% for one more year of your adjusted gross income. So those are the four main categories of what's deductible. They eliminated, it's not on here, they eliminated miscellaneous deductions, miscellaneous 2%. There was always a catch-all category. On here, the way I talked about 7.5% of medical, there was a category called miscellaneous 2%. If you're an employee, those were like if you're an employee and you had what's called unreimbursed business expenses. It's also legal fees, these are personal deductions, legal fees, accounting preparation fees, financial planning fees, estate planning fees, safety deposit box. A lot of personal deductions were subject to what's called 2% of your adjusted gross income. They eliminated that completely. So we're just going to stop talking about it. So it really leaves the bullets we just discussed: the state and local tax, mortgage interest, charitable contributions, and to a limited pool of people, your medical expenses. When you take those deductions and add them up, if you're married filing joint, let's go to this right here. In 2020, if those deductions add up to $24,008 or less, and you're married filing joint, then you're better. Then you don't take the itemized deduction. You just get $24,800. And so if you go through this, you're limited to $10,000 in real estate in state and local taxes. So that leaves $14,800 left. If we had a whiteboard, I'd be writing this down. So state and local taxes is 10. You have $14,008 left for your mortgage interest and charitable contributions. You could look at a mortgage statement to see what you paid to date, or contact your lender, or et cetera, to figure out what your 2020 mortgage interest deduction is going to be. I'm just going to make up a number for rounding purpose and say 10,000. Fairly high, but there are some people in this area with the large mortgages. So if it's 10,000 of state and local taxes, 10,000 of mortgage interest, the next 4,800, if you don't have 4,800 in charitable contributions and medical, let's eliminate medical for a moment, make it easier, most people. If you have less than 4,800 in charitable contributions, you're going to take the standard deduction anyways. Now, some people, when they hear that, well, I only contributed I might make 4,000 in donations in December. I always do 4,000. Barry, you're going to tell me that if I contribute $4,000, I don't get a benefit? I don't get a deduction? No, that's not what I'm saying. If you're a giver and you plan on give, please keep giving. You're already getting, you gave 4. Instead of thinking about losing 4, you gain 8. So because you're going to get a $4,000, 800 contribution. You're going to get a $4,000, 4,800 additional deduction on top of that, if you understand what I'm saying. So it's 10 for real estate tax, 10 for taxes, 10 for mortgage interest in my example. And if you give 4, you're at 24,000. But if you take the standard deduction, you get 24.8. So you really think of it as you get a bump rather than losing. And you still get, in this year only, you get 300 above the line. So it's going to be more like 25.1. Then it gets a little tricky. This is what, now we're getting into the planning part. I went through all that to get to this first bullet. Consider bunching. So if you're still in the mindset that you feel like you're losing 800, and in a way you are, and you know you always give 4 a year in December, well, what you can do this year, don't give the 4. Don't give the 4 at all in December. And some people spread it out over the year. You do it differently. I'm trying to keep a very simple example. You gave nothing throughout the year. You're going to give it all at the end in December. Instead of giving anything in December, you're going to get 24. You're going to take the standard deduction this year, 24,800, and give that 4 that would have been 2020. Give it all on January 1st, 2021. That's what we mean by bunching. You're going to double up next year, and it doesn't have to be January 1st. But as soon as, very early on in the year, you give that 4 in January, and you give your regular normal 4 next December, and for 2021, that's 8. So now in 2020, you're taking the standard deduction of 24.8, assuming all these numbers don't change, and then in 2021, you're going to itemize at 28. And then the following year, save up in 2022, but don't give it all. And then in 2023, double up, and so on. I'm having a hard time with this because my wife, she set us all up with all these monthly direct deposits, direct withdrawals, $10 to this organization, $50 to that organization. And I'm telling her we should shut all that off and put it all into cash in the bank account and maybe open up a separate bank account. So that way we have that lump number to give the following year. And all she said is, yeah, that's a great idea, Barry, you do it. So I'm not sure we're going to get to it. We're still just going to leave it the way it is. Then I'm going to get to this next bullet here, which also is something to consider. Are there any questions on that? I know it's sort of, I got some people faces and some not. So if your camera's off, I can't see if you raise your hand or something or speak up. But if you have any questions, this is a good time to interrupt on all that. And then moving on, but still interrupt if you need to. This next bullet that says, consider forcing. Maryland has a law. They knew this. When the IRS, when Congress changed the tax law and increased the standard deduction, the Maryland legislator cheered because Maryland has a law that says if you itemize for federal, you must itemize for Maryland. If you take the standard deduction for federal, you must take the standard deduction for Maryland. The standard deduction in Maryland is about $4,500 for married filing joint. I might be a little off slightly with rounding and inflation, but it's about $4,500. So if you're taking 24.8 federal and then 4,500 Maryland, if you're always just going to do that, that's fine. But in our example a moment ago, where I said you were at 24 before any charitable contributions, I'm sorry, at 20. If you're at 20 and you take the standard deduction, that's 24.8. But those 20 don't affect you for Maryland at all. You're all the way down at 45. You're not getting that 20 for Maryland. You're at 4,500. So people who used to be in like the $18,000, $19,000 deduction bracket, I'm over here, when deductions were 12.7, when the itemized deduction, when the itemized cutoff was 12.7, and you were in like the $18,000, $19,000, $20,000 itemized deduction category, you deducted 18, 19, 20 for federal, and most of that was also deducted for state, except for your state income taxes. There was a tweak for your state, but you still had a pretty high deduction. Now that you're jumping to the standard deduction for federal, you're forced to take the Maryland standard deduction, and by doing absolutely nothing at the state law level, your Maryland income taxes went up. because what was, say, 15, 16, a deduction went down to 4,500. The legislator knew this. They had a chance. Governor Hogan actually proposed breaking that up, allowing people to take the itemized, the standard deduction for federal and still itemizing for Maryland. Governor Hogan proposed that. This was a couple of years ago, and it was dead on arrival. So one area to consider, this is where it gets into a little bit of math and gets into planning, is taking the itemized deduction less than the standard deduction for your federal taxes in order to itemize for Maryland. If you're, I'm not going to do the math. I'm not going to show it up here. But if your itemized deductions adds up to $23,000 for the IRS for federal, even though it's 23, you're allowed 24.8. But you will be in a better tax situation to lose $1,800 in federal deduction at your federal rate and gain most of that 20,000, well, really about 15 after you back out your state income taxes. And this works better if you have a high real estate taxes that are deductible for state. So if you're paying high real estate taxes, this really works. Because those are still deductible, but your state income taxes are not. That you're better off losing some of the federal deduction to gain Maryland. There's a sweet spot there. I believe, and then this number, the itemized deduction number goes up every year, 24.8 this year to take standard, then 25.1. So you can't figure this out 1 year and use that number every year. It keeps going up a little bit. I don't know if I've lost everybody or if you're kind of following. Just understand, if you have a tax preparer, if someone pays for your taxes, bring this up. They can do this. If you use TurboTax, I've been told there's a feature to optimize between federal and state, whether you should leave some money on the table. So look for that. Look for that optimization if you're using TurboTax, or ask your account. If you're using a pay preparer, this is something they should be doing. We don't ask our clients, do you want me to optimize for you? Do you want me to consider it? It's something we do. We look into it and we tell them this is the best scenario for you. And this is what we did. But this is one area. And again, this goes, how does it fall into tax planning? It goes back to that bunching concept. This kind of defies the bunching thing. If you're at 1920 and you're considering paying 4 more, it gets a little tricky of how much more to pay or not pay if you factor in what I just discussed. Keep in mind, Maryland taxes are just under 9%. Federal taxes, we showed you the brackets up here. You might be in the 24, 32, 35% bracket. So there's definitely more bang for your buck on the federal deduction. In other words, for every dollar of tax, for every dollar deduction, you'll get a 24% or 32% savings for federal versus 9, a little under 9 for Maryland. So it's definitely beneficial to take the federal deduction, but there is a sweet spot that you probably can't do on the back of a napkin to figure that out. And a lot of that has to do with the tax. As an individual, there's very little individuals can do to plan, except in regards to buying and selling stocks, things that are going to trigger a gain. Do I pay the gain this year or next year? So knowing your tax brackets, do I sell all of the stock this year or half this year, half next year? Do I take a distribution from an IRA, from a 401k? Do I take a taxable distribution, pay the tax this year or next year? Do I pay charitable contributions this year or next year? Those are really your individual planning areas. You're not going to do tax planning. I'm not going to buy a house this year. I'm going to buy it next year for income tax purposes. That's usually not what's going to happen on your, you're not going to buy a second home based on the income tax consequence. You're going to buy that on market value. So that's, so there's not a whole lot. They've really cut down on a lot of the loopholes. That miscellaneous 2% category as a tax, I hate that it went away from a client perspective. I hate that it went away. It was sort of, we have clients that used it, but in many cases there were some questionable things going through there. That's one of the reasons why they got rid of it. So another area that made tax planning a little easier because people lost the deduction there. Although this was intentional at the IRS, at the government level, they reduced taxes back to these brackets. They reduced these brackets and eliminated deductions. So in a way, they did make things a little bit simpler and a little bit easier on the tax planning side. I'm gonna, up to this point, are there any questions? I'm gonna keep moving because I know I said I was gonna cover a lot on the first page. I think I went longer than I planned. They kept, if you know, they kept the child tax credit. Everyone get, if your child is under 17, you get the $2,000 deduction. If they're a dependent over 17, you get $500. I'm not going to go. They preserved certain things. These are here because they were thinking about eliminating areas. 529 plans. I'm jumping. You have this to read. I'm doing this on purpose because I want to try to get further down onto the more current, because these are just rules that have been there for a couple of years now. Raise your hand, speak up if you have a question. I can stop. 529 plans. You can now pay. It used to be college only for a couple of years now. You could also pay for private school, secondary private school, $10,000 a year per student. They discussed that they decreased the burden on alternative minimum tax by increasing the tax level you get hit. They doubled the state and gift taxes. Again, under a new, should Mr. Biden, President-elect Biden, be the president, I don't see this 11 million dropping drastically. I don't think Congress is going to go, it's too split of Congress for that to just arbitrarily happen. There was talk about that, but we'll see, who knows. And everything we just spoke about ends in 2025, and in 2026, it goes back to the old laws. So the standard deduction, for example, plummets again, back to that 12.7 number. For businesses, if you're a corporation, a C corporation, your tax rate is now 21%. It used to be as high as 35%. And again, back to the lowering taxes. If you're a partnership or an S corporation or self-employed, this isn't you. This is for entities that are taxed by themselves. A C corporation at 21%. Think Microsoft, think Boeing, and plenty of other and professional service corporations. To offset some of these tax rates, the deductions for businesses, they brought in something called the qualified business income deduction. It's a 20% deduction against business income for partners, S corporations, and self-employed. They talked all about tax simplicity and making tax law changes to simplify. If you're familiar with any of what went into this last year, this did not simplify taxes. This was sort of a gift to the tax preparers world, and I'm more than happy to give it back. This is a brutal deduction. There's a lot of work to get this right for some of the higher income folks. It phases out. It's not open for everybody. If you're under certain income limits, you get 20% of your business income. If you're over a limit, you get some of it. If you're over another limit, you get none of it unless it gets pretty complicated. I don't want to go through it. Just know that if you got it last year, you're probably going to get it this year. Let me know if you have any questions, because this alone could be an hour-plus seminar. Back to the planning we talked about. I'm moving on to depreciation. You can deduct up to 100% of asset if you buy new. If your business needs new computers, new computer software, new desks. If you're hiring and you need to fill up the desk area for equipment. If you're in manufacturing and you need to buy more, plant equipment, you can get a 100% deduction against your federal income taxes. That's called bonus depreciation. There's something called 179 and there's bonus. You must have income. These are the different tax code sections. If you have income, you can take what's called the 179 deduction, and it will not allow you into a loss. Bonus depreciation is a separate income tax code. You can take 100% of that also. You do one or the other generally, but the states did not come on board. So you have lower deductions for state income taxes as opposed to federal income taxes. So it becomes a little more complicated. But long story short, if you have money and you're trying to lower your taxes now, and you need equipment, and you can see, if you know you're going to need something in the first 6 months of next year, and you already know you're going to need it, if you have the money, you might want to consider doing it in December now for the deduction in 2020. The rule of thumb generally is anything I can do this year to lower my taxes this year, I'm going to go ahead and do it, and I'll deal with next year. So if you could accelerate deductions this year, or if you could reduce revenue this year, yes, you're kicking the can down the road, but you'll deal with that next year. And remember, this is what I meant by everything costs cash. You need to buy this equipment to buy this in order to get the deduction. You can't just go off and buy a car. You can't just go off and buy an Escalade or a pickup truck. There are limits on vehicles because years ago, Congress knew that at the end of the year, everyone would just go buy a new car. And the main reason is because most vehicles are used for business and personal. If you have fleet, if you have vans used 100% for business, It's got the name of your company on the side. Pickup trucks, cars, fleet vehicles. That is not the category I'm talking right now. Those are generally deductible. These are light SUV. These are the cars and pickup trucks and SUVs that are generally personal and business use. So all that driving that you do, you're driving your kids around to the different sporting events, etc. They put limits so that way you're not going to get the full deduction I just discussed in this bullet. There are limits that in 2020, I'm not going to go, you can take it up to, it's still nice. You can get up to an $18,000 deduction in 2020 if you buy a new SUV, light truck, car. In 2020, it's 18,000. Then it's 16,000 the year after. So if you buy that new $50,000 SUV, you're not going to get a full deduction, but it's still, you need to use it more than 50% in business, by the way, for these rules to kick in. So that is auto. Net operating losses. One of the big changes in the Tax Cut Act of 17 was they eliminated what's called the net operating loss carryback. If you're most businesses, when you start a business, and obviously in bad times like this, you tend to have losses. The old rule was you're allowed to carry that loss back for 2 years or 1 year. 2 years first. If anything was left, you carried it back 1 year. You could actually get refunds of prior year taxes, or you just carried that loss forward and you would get refunds. And you could actually, or lower taxes rather, if deductions in the future. And you could even eliminate up to 100% of your taxes with these losses. One of the rules was it limited the Tax Cuts and Job Act of 17, eliminated the carryback. So you could only carry it forward, and eliminated the ability to deduct 100%, and you were limited to 80%. Again, no one wants this. You have losses, but if you have losses as a business, they're trying to get you some cash by offsetting other income and get you some cash to go a little bit longer. The CARES Act suspended these rules for 3 years, similar to the old rules. And so you can carry back losses again in 2020. 2020, you can carry back your losses for 2 years and get refunds. Keep that in mind. If this was a brutal year for some folks, you can carry back those losses. If 2019 was a good year, 2018 was a good year, you can carry back your losses to 2018 and 2019 and get refunds. That involves tax tax forms, etc. But you can. Section 1031, it's a real estate specific law. We're not going to cover that. Another area that they eliminated was business deductions for entertainment. A lot of people you would take a client to a baseball game, you would take a client to the theater, to a show. You had Skybox tickets. Some businesses have boxes at Comcast Center or Xfinity rather for Maryland. Those are no longer deductible. This category fell into 2 deductions. It was meals and entertainment, M&E. It was deduction for meals and a deduction for entertainment. Everyone thought of it as one big bucket, but now you have to really think about it separately. There is no longer deduction for entertainment. If you take a client to play golf and you're playing, you pay for the golf, that golf expenditure is not deductible at all. At the end of playing 18 holes from playing golf, you then go to the clubhouse and have lunch. The lunch is 50% deductible. If you get one bill, or you're a member of the club, and if you get one bill for the golf and the food portion, since it's not broken out, there is no deduction allowed. It's assumed to be all entertainment. If you get 2 separate bills, one for the golf portion and one for the meal portion, you can deduct the meal 50%. If you take a client to an Orioles game, same thing. If the ticket to the game, at this rate, you might have gotten it from someone off the street for free, so that's not deductible anyways. But the food portion is 50%, but the ticket is not deductible at all. If you have a Skybox and there's no blending, it's just one large bill, it's not deductible at all. If your business is doing some kind of an outing for business development with another firm, and you can get an itemized bill that shows the food portion and the Skybox portion, you want that because then the food portion is 50% deductible. So that's a big change. There was a lot of grumbling that it's going to change the way we do business and things, but keep in mind, I'm scrolling up, they lowered the tax rates. That was part of the give and take. They took away that entertainment deduction and they lowered the tax rate. And there were a lot of people in that entertainment deduction that were pushing through their entire golf club membership, their season tickets to Redskins games, which included going to 3 games with the family. There was a lot of stuff going. I'm not saying it did happen. Maybe it didn't. You know, everyone's on the up and up. But long story short, it took that away for everybody, and they lowered tax rates. I always like to go back to that lowered tax rates part. Whenever they take away a deduction, I like to remind people that they also lowered the rates. So those are some of the big business deductions. And those are, other than the qualified business income, other than this 20% one, those are permanent. The individual provisions expire at the end of 2025, so starting in 2026, and the business ones continue on. Those are generally the old rules. When I say the old rules, the new old rules that changed in 2017 and they're still the law. I felt that important as a foundation. Couple quick points that it doesn't affect a lot of people. That's why I didn't talk about the retirees. This time last year in December, for individuals, they called it the Secure Act, setting every community up for retirement. So it was only in the retirement category, really. It used to be when you were working, you could not contribute to an IRA until when you turned 70 and a half, you could no longer contribute to an IRA. There's the contribution bucket while you're working, and then you retire, and there's the distribution bucket. They changed the rules for both. As long as you're still working, as long as you have earned income, we're not talking about dividends and interest and retirement income. If you are still working and you have earned income, you can contribute for as long as you're working. So not just 70 and a half, 71, 72, 73, 74, 75. You can keep contributing. For a 401k, that was always the case. Your employer may have a rule that forced retirement, especially for management or something, had a forced retirement age. But as a 75-year-old still working in a 401k, you were allowed to still contribute. But if you didn't have a 401k and you were just contributing to an IRA, they didn't allow that anymore. So now, as long as you're working, earned income, you can contribute within the rules and the contribution limits. You can make contributions. On the distribution side, they have something called required minimum distributions. We're not going to get into the definitions, but when you were required to take required minimum distributions when you turned in the year you turned age 70 and a half. And there were a whole host of rules about that half. That was annoying and confusing and complicated. Everyone's living a little longer. Everyone's working a little longer. That half rule was annoying. So they eliminated it and they upped it to 72. So you don't need to take requirement distributions, minimum distributions until the year you turn 72. So that's a fix. That's good. That gives everyone another year and a half. If you're retired and you need your money, you're going to distribute it. But a lot of people also have a 401k or some other savings and they don't need it. So they're letting people keep that in there for another year and a half. There was something called a stretch IRA. You're older, you're in your 70s, you pass away and you left your IRA to your grandchild. The way the rules used to work was the grandchild would then have to distribute that IRA over their expected life expectancy annuity tables. So they were 10. The grandchild, this is, if the next generation, if your child doesn't need the money, you left it to your grandchild and they were allowed to take that money out over their lifetime, over the next 60, 70 years. They call that a stretch IRA. You stretched it for years. There's only work for people who didn't really need the money. They eliminated that, and beneficiaries need, unless you're a spouse. If you're the spouse, it kind of just goes along on your table, your annuity table. But if you, and if it's somebody within 10 years, I'm not going to get into the fine print of the rules, but for the most part, if you inherit an IRA and you're not the spouse, but you inherit an IRA, it must be paid out over 10 years. It does not have to be paid out 10% a year for 10 years. You could wait till year 10. You could take it all in year 1, but if you take absolutely nothing, it must be paid out in year 10. You can't stretch it over a grandchild's life anymore. But again, with the Secure Act 529 plans, most of this long bullet talks about you could use up to $10,000 to pay principal and interest on an education. You used to not be able to pay student loans with a 529 plan, and now you can spend up to $10,000 to pay a student loan with a plan. And also apprenticeship programs, up to $10,000 on an apprenticeship program. So again, a lot of these don't affect a lot of people. but I like to mention them because you just never know who in passing you're on a Zoom holiday event next, in a couple weeks, and someone talks about something and, oh, Barry taught me this. You can be the cool one at the social gathering. So I like to bring up some of these ones that hit other people. Personally, I wouldn't really talk about it in public if I were you, but you never know. I'm just playing around. Those were personal, those were individual changes for businesses. There are some tax credits. This is an area where I'm going to talk about it briefly. You might want to read this later. If you have a benefit planner that you work with already, a payroll provider, talk to them about some of these. These aren't things your personal. These aren't things I would necessarily set you up with. I can tell you about them. These aren't things your accountant is going to set you up with. These aren't things TurboTax is going to set you up with. These are things financial planners, insurance, benefit planners. They know more than nuts and bolts. It's opening up retirement plans. It's getting tax credits for retirement plans. Definitely tell your accountant if you do any of these, or if you're curious about these. But a lot of times it's not the accountant that's going to do the paperwork for these. So if you establish a new retirement plan, there used to be a $500 credit. It's now up to $5,000 for opening up. Keep in mind that the government is trying to get people to save. That's what a lot of this is. They're trying to get people to save because you don't know what's going to happen with Social Security, right? Also, with IRAs and simple IRAs and 401ks, you can open them up a little bit later. The rules used to be by the end of the year. They moved it now to opening up before you file your tax return. That's this bullet over here. That's really just some of the retirement plan benefits. This is an area, so you can open up a plan now and get some benefits, or even have until your due date of your extended return, which would be next October. It's due in April. It could be extended till October, and you can still get some of the benefits of opening up a retirement plan. Any questions? I know I'm going pretty quick. I looked at the clock, and I'm just trying to cover some points that there could just be somebody that gets a benefit. So 2020, the reason I purposely, as much as there was a flurry of legislation, today's topic was tax, and not everything was tax. There were 3 rounds of tax relief passed, tax changes in 2020. The first one that's not even on here, the big one, well, one of them was just changing the due dates. April automatically paying July. That might have been good for a lot of people. As a tax preparer, I'm going to tell you right now, I don't want that again. Last summer was horrible. I like, as bad as an April I like, my life is geared for the April tax deadline. A quieter summer starts slowing down. I get back to work on all the extended returns. This year, just 2020 never ended. That's not a complaint. It's just me on a soapbox saying, do not extend it again, please. Let's get it done in April. Our lives are so used to April. Let's keep it that way. That's not even on here. That bullet I just described, that's not even on here. So in March of 18th, the Family's First Coronavirus Act, that was for family and medical leave. It required, it's through the Department of Labor, not IRS, not tax, that required some medical leave. If you had to qualify, you had to be sick, or someone you were caring for, a dependent, a loved one, had to be sick, and you took some time off. The Emergency Paid Sick Leave Act, I'm sorry. The first was if you were caring for somebody else. The second one, if it's you. They went under the same act, that you were required to get some number of days off, still get some pay. It didn't affect every employer. There was a certain number of employees were exempt from these, all done through the Department of Labor. And then there's a benefit for forcing you to pay sick leave. Employers got tax credits for paying that sick leave. If you qualify, or if you think you qualify, this is an area to talk to your payroll provider on. Your accountant may be your payroll provider. Bring it up. Ask if you have any benefits. Then there's also, we're going to get under the CARES Act, the next one. That was the Coronavirus Aid, Relief, and Economic Security Act. That's the biggie. That's the one that was the $2 trillion one. In many cases, the ones I just said before, if you're getting the tax credit up here, there are rules that you don't qualify what's called the Paycheck Protection Program. In many cases, you can't double dip. If you've got a Paycheck Protection Program loan, we'll talk about in a moment, then there's some tax credits from this act that you're not eligible for, one or the other. But definitely, there are some that do double dip. So definitely talk to your payroll provider, talk to your accountant to make sure you get all the benefits available. These kind of happened already. It's not a tax planning thing. You had sick employees. This is an area where they're trying to get this extended now. You had sick employees earlier in the year. It already happened. You just need to know if you qualify or not, or you got a paycheck protection program loan or you didn't. So you just need to know the rules, but it's not really a planning area. The paycheck protection program, all I'm going to really say about that, we're not going to go deep into that today. If you came on here for that, I'm sorry, I purposely didn't put it in the synopsis of what today is about. This committee, the Small Business Committee, will be doing a full hour on January 27th of the Paycheck Protection Program loan. I'll be a small part of that, and a coworker of mine who's really pulled this program up by, really doing a lot of work on this. She'll be spearheading it, and I'll be assisting a little bit on January 27th. Put that on your calendar. Shameless plug for that. That's where we're going to discuss this a lot. But the one thing to know for planning, the one rule that's coming as a lot of surprise to people, if you received a Paycheck Protection Program loan in the year you apply for forgiveness, you don't have to, that means you got money from, let's say, a $50,000 loan, you got money, you've applied for forgiveness, so you've gotten $50,000 from the government tax-free. That is great. The big surprise to people is the money that was used to spend on is not deductible. So that will reduce, if that 50,000 went to payroll, then your payroll deduction for the year it's forgiven is 50,000 less. That's coming as a surprise to a lot of people. But if you work through the math, it makes sense. It's the way everything in the government and the tax code has always worked. Tax exempt income does not allow for taxable deductions. If you have zero income and you get a 50,000, if you broke even for the year, that $50,000 revenue that you don't have to pay brings you back to zero. They're not letting you have 50,000 of deductions to have a $50,000 loss. It's not quite that simple, the math, but that's the gist of it. You're not going to get a $50,000 deduction with someone else's money, with the government's money. That's coming as a big surprise to people. So I just want to point that out. And that's a big issue for planning on the business side, on the business tax planning. If you're self-employed, if you're, whatever it is, if you received a loan, now if you're applying for forgiveness in 2020, then those deductions are not deductible in 2020. Even though deductions were paid in 2020, if you apply for forgiveness in 2021, then you're getting an adjustment in 2021. The year you apply for forgiveness, that you're not picking up the income. Definitely talk to your accountant on that one. If you got a Paycheck Protection Program loan, to understand how that's going to impact you. It feels like it's more taxes, but keeping in mind that you're not paying tax on the 50 loan in that example, or 20 or 30, whatever it might be for each person. One area I didn't see, that's this bullet here. There'll be a whole seminar on this in next month. It's 11 o'clock. I'm going to keep going a little longer. I'm not insulted if you just shut off and leave. I understand. Post a question if you have any. But we're almost done. I didn't see a lot of this one. A 50% refundable payroll credit up to $10,000 to retain employees not working. Again, you're paying folks to not work, and you're getting a payroll tax for it. Talk to your payroll provider on that. Nothing you can do now. It's kind of over. It's already happened. It's not a planning. You just want to make sure you get all the credits you're eligible for. This one, the delay of employer Social Security payroll. I didn't see this one. I didn't see a lot of this at all. This is a deferral. This is not an elimination, where instead of paying payroll taxes this year for cash flow purposes, you can split it into 21 and 2022. The employee portion was still due. The employer portion can be deferred. It just made for a lot of confusion. It was just easier in many cases for employers to just pay the payroll tax and be done with it. But if you owe payroll taxes that you have, just keep that in mind. If you've taken advantage of this, you're going to pay the payroll taxes in 21 and 22. There was something about leasehold improvements. If you're not in the real estate industry, or if you don't have an office with leasehold improvements paid for this year, it doesn't matter. It doesn't affect you, but you can deduct office improvements. This is back in the depreciation world. Let me know if I'm happy to answer this question offline. Expanded unemployment insurance. We discussed the net operating loss rule changes. I did that purposely earlier. That's one of the big ones that they're allowing, but it's a CARES Act provision that will expire. The refundable tax credit, that was those stimulus checks. People got $1,200 or $2,400 married, filing joint. Again, you can't tax, you got it or you didn't get it. They're talking about maybe paying more, maybe not. The next bullet is the $300 charitable deduction, which we already talked about above the line. Even if you're taking the standard deduction, you can deduct up to $300. So if you gave to, it has to be cash. If you give garbage to Goodwill, you can't, I'm sorry, your stuff from the house to Goodwill, you can't, hope people caught that. You can't deduct that, it's stuff. But if you give $300, you know, to the chamber or to any other charitable, you know, even though we're not a charity, I'm kind of kidding there. But if you give $300 to an educational institution or religious institution, et cetera, you can get a cash deduction for that. We discussed the required minimum under the CARES Act. If you're retired, the 2020 required minimum distribution is waived. This is only for people who are under the old rule. If you turn 70 and a half in 2020, you probably didn't take one anyways. Turned 71 in 2020. Hopefully you didn't take one anyways, that you knew about this rule. But if you were already 70 and a half, or if you turned 72, you do not need to take a required minimum distribution in 2020. You can completely defer that. You don't have to double up in 2021. It's just waived for 2020 because they were, I think they were anticipating the stock market to tank, which didn't happen. But they eliminated the required minimum distribution requirement. You can also, for qualified individuals, you can take a loan from an IRA. Actually, it's not a loan, I'm sorry. You can take out up to $100,000, that's individuals, married, filing joint. You can each take $100,000, so that's $200,000. If you qualify, this is for if you are sick, if you lost your job, if you're caring for somebody who is sick and you had to stop working. This is for people, this isn't for retirees generally, because they're already taking money out. This is for people that are still working and still contributing. You can take up to $100,000 out to cover your expenses as long as you're qualified if the coronavirus affected you. And when I corrected myself on it, it's not a loan. Loan implies you pay it back with interest. It's sort of a rollover. If anyone, there's a 60-day rollover rule. You could take money, anyone could take money out of their IRA right now and put it back in within 60 days. That's called a rollover. Generally rollovers are going from one IRA to another IRA. You could take out money now and then change your mind of opening a new IRA and put it all back in within 60 days, and that still qualifies as a rollover. If you qualify due to coronavirus, these same rules are in play, except you get 3 years. The 100,000, you get 3 years to put the money back in. You could put some back each month. You could wait till the end of the 3 years and put it all back at the end. If you don't pay it back, or the portion you don't pay back, or roll over, I should say, it's considered a distribution and it's taxable. But you have 3 years to put it back. That's big for people who were, drastically impacted by coronavirus, lost their job or something, and hopefully they're back on their feet. That over the next 3 years they could put the money back in. Now that was a big one as far as what changes are made, but it's only you must qualify. This is not for everybody. You must have been sick or taken care of someone who is sick, or had your job impacted by it. I'm sorry, you didn't have to. You yourself don't have to be sick, but if your job was impacted as a result of coronavirus. And they also waived the 10% penalty on distributions under the age of 59 and a half, facing virus-related challenges. If you're 59 and a half, under 59 and a half, and you take money out, it's taxable. It is always taxable. It's always subject to income, but there's also a penalty for taking it out too young. They waived the penalty 2020 only. You're still paying income tax on it, but they waived the penalty. Those are the major changes. For all the talk during the year of all these big things, there weren't that many small business tax changes and individual tax changes. They were mostly in these categories we just spoke about. The Paycheck Protection Program was huge. I don't want to understate that, but that's not really a tax concept. It's a small business administration loan that has a whole host of rules that we'll discuss next month. And then there are just some items that are expiring. The big one we talked about earlier was the 7.5% floor of medical expenses. Would have normally expired this year, but they extended it to 2021. I'm not going to go through all of these, but also one that's changing is all the solar panels, wind, geothermal, the projects we've been seeing a lot of construction over the last 5-10 years, businesses and individuals. There's always been a 30% tax credit for these projects, whether it be individual or business. And starting this year, in 2020, the year that passed, that 30% credit was reduced to 26%. Doesn't sound like a lot, it's 4%, but do the math, it adds up. These systems are pretty expensive. So in 2020, the credit is reduced to 26%. In 2021, it's 22%, and it's eliminated completely in 2022 and forward. There's been talk about Congress bringing this one back up. As you can guess, the lobbyists are fighting hard on this one. The oil and gas industry does not want it, shocker. And of course, the renewable energy industry does want it. I'm not even going to venture to guess on that one at all where this is going to head. But just know that if you've been thinking about a system, if you're an individual, if you're having it done now, if you're working on it, if you're doing this right now, you're going to want this placed in service. You're going to want it working by the end of the year to get a 26% tax credit. And we've had this 30% number, some people have at least, ingrained in our head for years. It's now ratcheting down. Just know that. That brings us to the end of page 4. I know I jumped a little bit to get us to the to get us finished. I apologize that I went about 10 minutes over before any questions. I'm here. I'm not shutting off. I understand if you need to shut off, but if anyone has any questions, thank you.
Yeah, if you have any questions, just feel free to unmute and go ahead and ask Barry. And we will be sending out Barry's contact question offline. I'll give everyone a moment to pose any questions. If you have not had a chance to place your information in the chat, now would be the perfect time to do that as well. We only send out information for those who joined on the call who provided their information. So if you want your information to be included, make sure that it's in the chat. All right, doesn't seem like anybody's going to pose any questions. So we'll go ahead and wrap this up. Thank you all for joining us today. We hope you'll tune in for future webinars, including our event next week on commercial real estate. That is next Wednesday, also at 10 a.m. You can find information on that event and more on our website, www.centralmarylandchamber.com. We'll share the link to the video from today's session and attendee contact information with everyone later today. Thank you again to Barry for presenting on this very important topic, and your company, Bormel, Grice & Hewitt, for allowing you to do that. We hope everyone has a very happy holiday, and we hope to see you at another event soon.
Hey,
Everyone,
Kim.
Hang on 1 second.
Yep.
Sorry.
One quick thing. I know I threw a lot of information out really fast. If you have any questions, I like to keep it as it pertains to today's session. This isn't like an open invitation for all things tax. But if you have any questions that's stemming from here, you get off, maybe you're not asking a question right now because you're in a rush. This is our office phone number right up here, 301-953-3259. Feel free to call and ask for me. I'll be happy to talk to you for a little bit with any of your questions. My email, my first name is Barry, B Fields, B-F-I-E-L-D-S, and it's at up here, the bormel-grice.com convention. So it's B-F-I-E-L-D-S at bormel-grice.com. Again, please respect me a little bit and not open this up into a full-blown tax planning session. But I'm happy to work. There was a lot of thrown really fast. It's just the nature of tax. 1 hour is you can't do this for 9 hours either. You guys would have signed off. But you got the idea. So just feel free to follow up if you have any questions. Thank you.
and Barry, there are a couple questions in the chat. I'm just reading through those. It looks like Maryland has one that's related to PPP loans. That might be one that is for the next session in January, but I'll just read it real quick. My PPP loan is through Square. I've been given the impression by Square that they will send me the application for forgiveness, but it might not be till next year. And she asks, follow up, how might that affect her taxes for next year, or for this year, for 2020?
Again, it's on the tax side. If you apply in 2020 for forgiveness, those deductions that it affects will not be deductible in 2020. That's really the big tax side of it. There's a lot of paperwork and calculations depending on the size of your loan and the size of your business. When I say a lot, there is an easy form. You might want to definitely check with your lender as to which form applies. Definitely check in for our program next month. But on the tax side, it's really if the revenue is going to be forgiven, then the expenses that money went to pay for is not deductible.
Okay, and then Amy had a question. She often drops off donuts or some other food item to businesses on a quarterly basis. Is it a stretch to call those meals for the deduction?
This gets into the gray area because that's more of that's kind of in the gift area. I don't want to even call it a gift. I wouldn't call that it depends on how, as long as you're not a pig, as long as you're not spending thousands of dollars a quarter on donuts to clients, it's nominal, it's going to a few folks. I wouldn't necessarily call it meals. That might even, supplies, gifts. I wouldn't call it a gift. Some sort of, it's not really a meal. It's kind of like promotion, marketing, business development. In all fairness, the IRS might sort of disagree with that, but it's not a meal. The concept of a meal is you took someone out and they would have paid for lunch without you. That's a meal. They would have, but you've gotten something out of it. You've talked business, and your half, you would have eaten lunch anyways. So your half is not deductible. That's a personal. But since you're paying for that person to talk about business, you're getting it's not quite like this. That's how I look at it. You're getting to deduct their half of the meal because you're getting something out of it talking about business. That's not what this is. You're dropping off a token of your appreciation. So I would put that into a different, I wouldn't call it meals, because meals, I would take the full deduction, as long as not being a pig, and marketing, promotion, materials, something in that category. And I just want to be very clear that there's a possibility that upon a careful scrutiny of the IRS, they may not agree with me. But you could also make an argument why that is important. It's building up it's building up this business relationship with this client, because now when they think about who they're going to call the next time, they're calling you. They're calling the donut. I'm calling the donut lady.
All right. Any other questions before we end the recording and end the call? All right. Well, I want to wish everyone a very happy holiday, and we hope to see you on one of our upcoming events. Hope you have a very happy and healthy holiday season, and if we don't see you in an event upcoming in 2020, we hope to see you in 2021. Everyone have a great day.
Thank you.